Hi everybody, welcome back to our mutual fund educational series. This is our fourth video. Thank you so much for giving so much of love to all the three videos that we've recorded so far. If you've not seen them, we've given the link in the description section. This video is actually going to demystify everything that you really need to know about taxation to do with mutual funds. And I'm going to make it so simple for you to understand irrespective of your backgrounds. I assure most of you who will stay with us through the end of the video will understand everything about mutual funds, taxation related matters. Hi everybody, my name is Kirtan Shah and I'm the co-founder and CEO at Financial Planning Academy. At FPA, we are amongst the largest educational institute when it comes to international certification programs like the CFP, CFA, ACCA UK, CMA US, investment banking operations kind of program. We have operations across the country and we've trained over 5 lakh students over the last 12 years that we've been existing. Bringing back focus to today's video, what you really have to understand are three things if you really want to understand mutual funds related tax issues. First, there are funds which will qualify as equity taxation funds. There are funds which will qualify as debt taxation funds. And then there are funds which will qualify as debt plus indexation category of funds. Once you understand this, 80% of what you really need to understand around mutual fund taxation will be clear. So first let's focus on that. Now, which funds are classified as debt funds? So if you see, I very categorically mentioned here, any fund in which they hold less than 35% equity is categorized as debt taxation fund. What does that mean? Let's say if you've got 100 rupees and you've invested in a particular mutual fund, if that mutual fund is investing only up to 34%, which is less than 35%, only up to 34% in equity and equity related instrument, then that scheme will classify for debt taxation. What is debt taxation? Debt taxation means that irrespective of how long do you hold the fund, for 6 months or 6 years, whatever gains that you've made will be taxed at the slab rate. So let's say you invested 100, it became 150, so you've made 50 rupees of capital gains. Now this 50 rupees is taxed to you at your slab rate. So let's say if you're in the 10% tax slab, the 50 rupees will be taxed at 10%. But if you are in the 30% tax bracket, that 50 rupees of capital gains will be taxed at 30% and you will have to pay 15 rupees of tax. It does not matter whether you've held on to the fund for 6 months or 6 years, you will have to pay as per your tax slab if the fund is under the debt category. The second category is something called as debt plus indexation. This is a very interesting category because a lot of us don't really understand this and the advantage that this tax category really brings along. First, let's understand what it is. So let's say if you've invested in a fund which has equity and equity related instruments between 35% to 64%. So you give 100 rupees to the fund and the fund is invested in equity between 35 to 64%. Then this category of mutual fund will be eligible for something called as debt plus indexation advantage. What does that bring on table? So let's say if you've invested 100, that became 150, but your investment horizon was less than 3 years. Then what you still pay is slab rate, right? So if you've invested for 2 years and 11 months, then you still pay on the 50 rupees of capital gains that you've made 30%, which is 15 rupees. But let's say if you've invested for more than 3 years, let's say you've invested for 37 months, then you get a unique advantage that you pay 20% with indexation. What does that mean? Assume you stayed invested for 37 months, your fund generated 9% return, but in the same 37 months, you saw that inflation was 6%, which means broadly the net return you've made is only 3%, 9 minus 6. So the tax rule says that on the 3% that you've made, I will only charge you 20%, irrespective of the slab that you are in. Even if you are in the 30% tax slab, you are still charged 20% on the 3%. Why is it called indexation? Because you are not charged 20% on the full 9%. You are saying 9% was the return. I will minus 6% because my expense also went up by inflation. The remaining 3%, I will pay 20% tax, which is 0.6. So if you've made 9% return, 0.6 is the tax. What you actually make or get in hand is 8.4. Who qualifies for debt plus indexation? Funds which have equity exposure from 35 to 64%. The third category is equity. Who gets equity taxation? Equity taxation is for somebody who, the fund in which you have 65% or more of equity investment. So 100 rupees invested in that fund, but the fund has invested 65 or more in equity, that will get equity taxation. What's the taxation like? If you hold the fund for less than 1 year, then on the 15 rupees of gain, 50 rupees of gain that you've made, you will be charged 15% tax. But if you hold it for more than a year, you will be charged 10% tax. Now, theoretically, you will feel this 10% is lower than the slab rate or 20% with indexation, and hence most of us believe that equity taxation is the lowest or the best taxation, right? But actually, debt plus inflation is the lowest taxation, and I'll explain to you why do I say that. Let's say in all of these three categories, let's hypothetically assume the fund has made 9% return and 6% is inflation, and you are holding it for more than 3 years, let's say, right? So how much is your net tax after tax in debt? So let's say 9% is the return, 6% is the tax, 6% is inflation, but you will have to pay 30% tax on 9, which is 2.7. So what you are actually getting in hand is only 6.3. So 9% return, 6.3 is what you are getting in hand. So let me write 6.3 here. Okay. What happens in debt plus indexation? In debt plus indexation, what happens is, even if you've made 9% as return, 6% is inflation. So what you are actually getting taxed on is only 3%. How much do you get taxed on in 3%? 20%. 20% of this 3%, which is 0.6. So what you net make in hand is 8.4. In equity, if you've made 9% return, 10% is the tax. So 0.9 is the tax. What you make in hand is 8.1%. So if you see theoretically, your debt plus indexation is a far superior tax proposition than even equities. But then why do we practically feel that equity charges us less in terms of tax? Because please understand, debt and debt plus indexation typically will make you 9, 10, 11, 12% kind of returns. Largely 9 to 10% kind of returns. But equity can make you much higher, 15, 16, 20. So when you make 20% returns on equity, right, and you pay 10% tax, you are net still making 18%. So you will be like that, even if I have to pay 2% out as tax, I'm still making 18%, which may not be possible when you are doing debt plus debt or debt plus equity. When you are doing debt or debt plus indexation type of funds. So when you consider lower returns in the range of 8, 9, 10%, then debt plus indexation is a far better category to invest in from a tax perspective. But when your returns go to 12, 14, 15, 16, that is when after tax net you will make more on equity. But to reiterate, debt plus indexation is still far superior when you are investing in a fund which has lower return probability. Why is this important for you to understand? Because multi-asset funds largely will try and tell you that I am giving you equity taxation, and hence it's a better proposition to invest. But understand, in multi-asset funds you are expecting lower returns, and in lower returns, debt plus indexation is a far better opportunity. So while you are choosing multi-asset funds, do not get carried away and choose equity taxation funds because you think that theoretically equity will be better tax opportunity. In multi-asset funds, actually debt plus indexation may turn out to be a far better opportunity, provided that the returns are in the range of 8 to 12% kinds. That's one. Second thing that you have to understand is that in mutual funds, when we do arbitrage, And I've explained to you arbitrage in the last video that we did, that in mutual funds, arbitrage is actually considered as equity taxation, in spite that the risk is like debt. You are actually not taking a lot of risk while you are doing arbitrage, but because you are doing arbitrage in equity, arbitrage is considered as equity taxation. So a lot of funds like equity savings fund, multi-asset funds, all of these funds, what these funds do is, because they want to give you equity taxation, uh, so what they do is they actually invest only 20-30% in pure equity. The remaining they invest in arbitrage fund. Together they increase the proposition of both of these together more than 65%, so that from a taxation perspective you still get equity taxation because arbitrage is considered as equity. So always keep this in mind while you are trying to evaluate or look at equity savings and multi-asset, specifically multi-asset actually as a category. But there is still a very large advantage of debt plus indexation over and above that I just explained to you. And what is that? Imagine in December 2023 you are investing in a debt plus indexation kind of category fund, right? And you withdraw your money in March 2027. Now, theoretically speaking, you've invested for largely around 39 months. You've not invested for 4 full years, right? You've invested slightly higher than 36 months, but you still get indexation advantage for 4 years and not 3 years. So your return is 9%, but you have to minus more than 6% because it will consider indexation for not 3 years but 4 years. Because while you are trying to do this calculation of indexation, it is done on financial year basis. So if you invest in December 23, only for 2-3 months of investment, they will give you full 2023-24 year of indexation and plus the 3 years that you are investing. This is another big advantage of investing in debt plus indexation category of funds. From a tax perspective, if you can use it really well, you can really add a lot of advantage from a tax savings perspective versus doing a debt or an equity. Plus, please remember, this is applicable when your fund returns are 8, 9, 10% kinds, right? If your fund is going to generate 12-15%, you are better off paying even if slightly higher tax in equity, because your net after paying tax is still in equity going to be much better, right? Now, 2-3 things from a tax perspective that you have to understand. You can invest in ELSS funds in mutual funds and take a deduction up to 1,50,000 rupees. So if your income is 5 lakh rupees and if you've invested 1.5 lakh rupees in ELSS fund, you only end up paying tax on 3.5 lakh rupees. That's how you save 45,000 rupees of tax there. Also, let's say if you've invested a lakh of rupee in equity mutual fund, you held it for 2 years. Now the fund has become 2 lakhs, right? Which means you've made a 1 lakh rupee of capital gains. You can actually sell the fund at 2 lakhs, book that 1 lakh rupee of capital gain and pay no tax, because every year in equity mutual funds you can book up to 1 lakh of capital gains and pay no tax. So let's say if you booked 5 lakhs of capital gains, you actually pay capital gains tax only on 4 lakhs and not on the full 5 lakh. Every year 1 lakh is allowed as tax free. So what a lot of people actually end up doing is every year book profits in a way that 1 lakh is booked and they don't pay tax. But while you are trying to do this strategy, please keep in mind reinvestment risk, right? As soon as you receive your money, try and reinvest it back, because if you try and then time the market to save that tax, you might end up losing and not able to reinvest the money back. But do keep this in mind while you are trying to do this. Now, to sum up everything that we've done so far, right, very quickly, there are 5 things that you have to understand. All the equity funds, the first video that we did, all the equity funds that you will invest in, you will get equity taxation. And I've explained to you what equity taxation is. All the debt funds that you will invest in, you will get debt taxation, right? Hybrid is where there is a slight confusion. So let's say if you are in conservative hybrid, because conservative hybrid invests less than 35% in equity, you will get debt taxation. Balance hybrid, because it is investing more than 35% but less than 65% in equity, you will get debt plus indexation. And aggressive hybrid is more than 65% and hence there you will get equity taxation. I am using this because using and talking about this so confidently and swiftly because I'm assuming you've watched the first three videos and you know what is conservative hybrid, balance hybrid or aggressive hybrid. If not, do watch the hybrid category video, which was the third video. You will understand this far better. But this is the whole list that you really need to understand from a taxation perspective while you are trying to understand mutual funds in terms of tax. So guys, I hope you've been watching the series. You've watched the first three episodes. If you've not, please go and watch the playlist. It's there on the channel. If you've not subscribed, please do subscribe. Click the bell icon. Do please comment and tell us if there is a specific video that you want us to make, or if you are loving it, is there some change that you really want us to make. But I hope that in this 15 video series, if you stick by us, you will become a very prudent mutual fund investor, and that's the whole objective of this series. Thank you so much, and I hope that you are enjoying this.